Hi, I'm Jimmy. In this video, we're looking at which investments are better, small cap, mid cap, or large cap companies. Then, towards the end of the video, we're going to look at some potential ways we can use the information that we get out of this video to build a better portfolio. Okay, so let's quickly define how we're breaking up these categories. So for the small cap companies, I'm using the iShares Small Cap ETF, ticker symbol IJR, to represent small cap companies. And just so we're all on the same page, CAP is simply short for capitalization. So a small cap company is a company that has a smaller market value on the stock market. Now, I don't mean the stock price itself. We're looking at the total value of the whole company. Okay, so IJR has a company's worth about $6 billion and down. Now, I only saw 2 of the 500 or 600 companies in the ETF worth about $6 billion. The rest were generally worth $4 billion and something dollars and down. Now, I'm spelling this out because there's no hard and fast rule as to what defines a small, mid, or large cap company. So that's where we're focusing with them. Then we have mid cap companies. For that, we're using the iShares Mid Cap ETF, ticker symbol IWR. Now, most of their companies are somewhere between $5 and $30 billion market caps. Now, they have some companies that are below that, but broadly speaking, most of them fall in that range. Okay, simple enough. Now for the large cap ETF, we're using the iShares Large Cap ETF, ticker symbol JKD. As we can see, I stuck with the iShares family here. Now, the large cap companies range anywhere from Apple, which is the largest company worth over $1 trillion, and they fall all the way down to slightly less than $20 billion. Although a large percentage of those companies, I think it's about a third of them, are worth at least $100 billion. Okay, now let's look at the results. So when we look at the results for each of these 3 ETFs through 2019 so far, well, we can see that the large cap companies have significantly outperformed, and that probably makes a lot of sense when we think about how companies like Apple have done so well in the recent year. When we skip over to 2018, well, we can see that 2018 wasn't a very good year for stocks in general, since all of these returns are negative returns. Then in 2017, well, it seems that the stocks at best performed with the largest companies, but in 2016, there we saw that small cap stocks performed better, almost double what both mid and large cap stocks did. Okay, now let's switch this chart to a chart of all of the years going back to 2006 for each of these 3 ETFs. Now we can see what I was looking at with this is I was trying to find some sort of pattern that made a lot of sense. For example, if small cap companies did well one year, they didn't do well the next year, or vice versa. And there was no consistent pattern that seemed to be true each time. They broadly seemed to move well with each other, but overall, I couldn't really find a pattern splitting these companies up. But when we add the averages for each of these companies going back the past 10 years, well, we can see that large cap led the way, then small cap companies came in second, and then mid cap companies came in third place as far as average annual performance. Now, when I was doing this research, I deliberately went back to before the Great Recession because I wanted to see how each of these groups did in the run-up to a market crash and an eventual market crash and then the recovery. Now, overall, it looks like there's not too much of a difference between each of them. But here's where I think it gets a bit more interesting. Going back to 2016, just as an example, well, we can see that small cap stocks perform the best. But look at what happens when we switch to the top 10 performing stocks within this ETF for that time period. And what's interesting to me is look at how high these returns are. And then when we switch over to mid-cap stocks, well, their top 10 did good, but we can see that they didn't do quite as well as those small cap stocks did. Then when we switch to the large cap companies, well, we can see that the large cap companies, although they had solid performance, they didn't put up anywhere near as impressive performance as the top 10 companies from the small cap group. When we switch over to 2017, well, we could see a very similar story. Small cap stocks had the best performing individual names within the group. Mid cap stocks did good, although not as good as small cap stocks. Large cap stocks did respectable, but not great, especially compared to the small cap stocks. 2018, once again, same thing. Small cap, mid cap did decent, pretty good, but large cap, although decent, didn't do nearly as well. Same is true year to date for the 2019 stocks. Now, I bring this up because I think that this actually makes a lot of sense if we think about it. Clearly, it would be easier to double or triple or quadruple a $1 billion company than it is to triple a $100 billion company. So what does all this mean for our investment portfolio? Well, let's start with the key question. What's better, small cap stocks, mid cap stocks, or large cap stocks? Well, when we look at this chart, we can see that on average, large cap stocks seem to perform better. So if we're buying a broad basket of stocks, staying diversified and sticking with large cap companies makes the most sense. On average, they've done the best. And assuming that we believe history will at least somewhat repeat itself, it makes sense to stick with this sort of mantra of investing. But now let's imagine that we want to get bigger returns than the averages. Well, we can go with the large cap winners from last year. They're doing quite well, but rarely are we going to see our money double in a single year or triple if we're owning large cap companies. But if we switch over to small cap stocks, well, here we can see consistently huge returns as we jump from year to year. Now, a while back, I read a very popular book called The Rich Dad, Poor Dad by Robert Kiyosaki. And one of the things that struck me about that book, one of the pieces of advice that the author had, is that he said that he liked to invest in small cap stocks. Now, at the time, I wasn't really focused on that. I've always paid more attention to large cap names. They're easy to track. There's more information out there on them. There's more research on them. But now I realize what he's talking about. So if we do our own research, and if we really want to swing for a home run, well, I think the key takeaway here is that there seems to be way more opportunities in small cap stocks, or at least there has been historically more opportunities in the small cap space. Now, the key to this actually working is doing our own research, because as we could imagine, the risk of a small cap company is also much, much higher than that of a large, stable company that's worth over $100 billion. So this goes back to the old saying of higher risk, higher reward. Now, if you're not really 100% sure about how to research a company, well, I actually did a video where I break it out into 8 steps. You can find a link right here and a link in the description below. So that could be a good next video to watch if you're interested in researching more companies and potentially getting a higher return. So thank you for sticking with me all the way into the video. I really appreciate it. I'll see you in the next video.